we've had about 30 years of disinflationary forces that allowed companies to not focus on profitability and allowed companies to be, I would say, much more, the prioritization to top line growth has been much more in line with executives in general and what they've been chasing for. And that caused a setup of businesses that would never survive in a rising cost of capital environment. And so this is an important change because now we've had long duration assets leading up to the market. So if we think about where large capital allocators are today when it comes to their portfolio positioning, most of them have been doing what's called a risk parity idea, where they pair both ideas of being long equities and being long treasury markets and fixed income in general. And so mostly treasuries actually. And so what we have is that the majority of the equity positioning really came from technology and more specifically software, and drove the valuations of those companies to extreme levels. I mean, we saw back in February of 2021, most of technology companies trading at 50, 60, even more times sales. And now they're still trading at very hefty multiples of 20, 30 times sales. But some of those companies are down 50%. The majority of that is part of the ARK ETF. And so ARK ETF has been declining since February of 2021. And that is what I refer to on the change of leadership. I mean, that is a major change. We haven't seen that leadership come back, and I don't think it will. I think this is going to be much more permanent. And at the same time, in 2021, we had, just as an example, oil and gas exploration and production companies had their best annual performance in 30 years. And so, we're seeing this shift out of technology and out of treasuries into natural resource businesses and into some other assets too. But the majority of that is coming into tangible assets, in my view, and majority of that is going into natural resource businesses that are linked to those underlying securities. So I think this is a big change in the markets that we've seen this a few times in the past. We've seen this in 2000. We've seen this back in the 70s. And why did we see that? Well, because we saw equity to commodities ratio reaching historical lows. And we've seen this happen recently now. And now we're seeing commodities outperforming the overall equity market. So I think this is a trend that will continue. I think that we shift away from buying the dip on the equity markets to buying the dip on commodities, buying the dip on tangible assets. A day like yesterday, or I don't know when this is going to be aired, but any day that you see oil markets declining significantly, or silver or copper, I think you want to be taking advantage of those days because there is a chronic issue in the markets of major underinvestments in natural resource industries, and so it's something you cannot fix over a short period of time. It's something it needs to be fixed in 5 to 10 years from now. And unfortunately, most of the policy making right now are not addressing those issues, are actually moving away from that. So, and then you hit on top of it with the geopolitical problem that is exacerbated by the amount of debt in the system. Debt leads to wars, wars leads to debt. They're all always together. So yeah, I mean, that's basically the way I'm thinking. I think we're in a repositioning environment coming out of those long duration assets, out of the risk parity strategies, and getting into a place where gold is going to become relevant again. It's going to become a hedge, a very critical part of anyone's portfolios. I mean, not enough institutions have gold, not enough institutions have natural resources. And so I mean, just think about what we're seeing of how markets are broken now, with commodities going up 200% on, this is and basically bankrupting people and bankrupting companies. I mean, this is supposedly a normal, not a normal move, but it's not too much out of the normal for you to see, somebody going out of business because of a 200 or 80% move on an asset. So there's a lot of people levered on the other side of this that need to unwind those trades still, and it's going to create a lot of movements here. But that's all positive for tangible assets in my view.